that? Do you think that regulators were right in the regulatory responses they brought so far? Do you think there's anything more they should do that they've...
There is an ESMA proposal, right, on ETFs. Some points are being addressed, some are being missed, in my opinion. The truth is that these instruments are giving the possibility even to retail investors to take exposures which they normally wouldn't be able to or shouldn't be able to. So you have double long ETFs where you can leverage your position through an ETF. You can short markets through ETFs. Should these be accessible to retail investors? Possibly yes. But this is the question I think that regulators are asking themselves. With the history that we had, should retail investors have access to these innovative products? It's a question.
I think it's still very much an open question, and also with regulators. We see that the European Commission is still concerned indeed by this, what they call the retailization of complex products. Yes. And this is still a theme they are working on. And for instance, in the consultation paper published last year, in preparation of a new revision of the UCITS directive, this is one of the themes that was addressed by the Commission in the consultation paper.
One of the ESMA guidelines refers to how ETFs should be named. I think we already discussed, for example, that UCITS, it's a wrapper which clearly gives retail investors, institutional investors protection. There's no question about that. But the problem is here in Euroland, there are ETFs which aren't UCITS compliant. So the fact that, for example, based on this new guideline, that these UCITS have to be called UCITS ETFs, I mean, that's a real positive. You know, talking about this guideline, and Jonathan, you're the expert on the legal stuff, but let me say this, you know, just by making these disclosures more prominent in the KID or in the offering documents doesn't mean that people are going to read them. So, you know, that's another thing. Getting back to what you're saying, Aldo, I think that ETFs are fine as far as retail clients are concerned. There's no reason why they shouldn't have exposure to ETFs. The only issue, however, is there is a real ignorance as to how these leveraged ETFs work, for example. And there has to be some education, but you know, you can't regulate stupidity, so to speak. I mean, at the end of the day, you know, I'm sorry guys, but you got to go out and you got to make an effort to learn and to know what you're buying, right? So, but clearly, the inverse ETFs, 3 times inverse ETFs, you know, you've got significant tracking error over a long period of time. These things are just designed to replicate on a day-to-day basis, certainly not over a long period of time.
Thank you. No, maybe moving or leaving regulatory concerns aside for a moment, I wanted to ask you, we highlighted in the beginning of this panel session some of the strengths of ETFs, like cost efficiency, transparency, and so on. How do you think, Aldo, Joe, that this could challenge the business model of actively managed, more traditional investment funds?
They are a challenge, definitely, because it's much more practical as an investment vehicle. Obviously, there isn't the level of disclosure, there isn't the level of regulation, and that is something that we were discussing. But it's much more convenient to buy an ETF, definitely. And therefore, it's a challenge for these funds. And over a period of time, because these funds are able to lower their cost of operation, okay, or to leverage on the assets they have, over time, they outperform the traditional funds, or they should outperform. And therefore, it's a challenge, definitely.
Does that mean, if I understand you correctly, that if we look again in, I don't know, 10, 20 years' time to the market share of ETFs I was highlighting in the beginning, there would be a significant shift in the proportion of...
Definitely. I'm expecting growth in the ETF market in Europe to catch up with what happened in the US, definitely. The issue is on concentration of market participants as well. It will take the big US players to enter Europe to have that type of growth, but it's bound to happen.
Getting to that, Vincent, the global ETF market, let's put it this way, in 1993, the first ETF was the SPDR, the S&P 500 ETF. So in 1993, we had one ETF. Today, there are somewhere in the vicinity of 3,300 ETFs. The assets within global ETFs are in the vicinity of $2 trillion. The assets within global funds are in the vicinity of $25 trillion. I guarantee if we meet here 10 years from now, the 2 is probably going to be 6, and the 25 is probably going to be a lot less. There's no question that more and more investors, more and more institutional investors are realizing that ETFs just are an excellent way of generating alpha, excellent way of getting exposure quickly, excellent way of exiting exposure. So there's no question in my mind that ETFs are going to grow. They're here to stay, no question about that.
Which leads me to another question. For the time being, the ETF market, certainly in Europe, is essentially an institutional market. Investors are essentially institutional clients. Do you see possible evolution in that sense as well, and an opening of the ETF market also to retail investors, and what are the possible barriers to such evolution?
We're seeing regulatory developments where the retail distribution is being regulated, and in Europe especially, it's the big banks that are promoting ETFs. Now that brings, I want to carry on Joe's argument, that brings some questions as well, because you have these big banks that are the promoter of the ETF, they're the swap counterparty, they're the prime broker, they're the custodian, they're the depository for the reference basket assets. So are we getting into a situation where these entities are really too big to fail through the CTF business? And again, if it's going to develop, it has to go down the retail route, and the best positioned players are the banks which have big retail distribution networks.
Okay, thank you. Maybe echoing on some of the presentations we've heard this morning, I wanted to talk about the opportunities that ETFs may create in Malta. What's in there for the Maltese industry? What are the opportunities? Joe, maybe you wanted to start with that.
Well, I hope there are a lot of opportunities. You know, obviously earlier today we were talking about how lovely Malta is. It's a sunny place, and it's a wonderful place for funds. And I would love it if iShares opened up an office here. I see some lawyers here. I think they would love it if iShares opened up an office here too. You know, I don't know. To my knowledge, I haven't heard of any ETF providers looking to domicile a fund here. Remember, just because you domicile a fund here doesn't mean it has to trade here. I think it would be a good thing. I'm not sure if that's our position of strength, because as you all know, a lot of ETFs like going to the Luxembourgs and to the Dublins of the world. Jonathan, what do you think?
I think I can only sort of look at it from more of the sort of back office perspective, but I think there are two things. At the moment, Luxembourg and Ireland, as you say, dominate the ETF business in terms of the place of domicile, in a way the sort of place of sort of back office functions. There would be no reason why another EU member state couldn't take on that role as well, particularly if there were other competitive advantages that it may be able to offer. I think you make a very good point, though, which is, as illustrated by the earlier slide, given at the moment that the ETF world is so heavily concentrated among a limited number of providers, it would be hard, I think, to encourage some of those to change what they do at the moment, particularly given one of the benefits of ETF is its speed of formation, limited cost base. And to that extent, it's probably a little different from some of the other investment products where you can see, that there are more opportunities among to get an entry point into the market. That said, though, I think to the extent that Malta has a very active and thriving financial services business, it ought to be the case that everyone should be looking at the developments of ETFs very closely, just as people are looking at UCITS, just as people are looking at hedge funds, just as people are looking at everything else. Because to the extent that other providers may come into the market, there could well be opportunities. I think, though, it does require a fair amount of investment because of the nature of the product and the nature of the margins involved. You almost have to sort of have a readily available platform for people to be able to use to be confident to think of you as a country that has an appropriate platform.
My point of view is that we might have an opportunity, and you mentioned the cost factor, and I'll explain why. I think it's unlikely that you'll have another FTSE 100 ETF or S&P 500 ETF. There are enough. Where we're going to see new ETF, it's going to be in niche products. There's where the development opportunity is. Now, when you have niche products, you'll have lower primary market amounts being gathered, and costs are going to be determining. Now, when we compare the jurisdictions, I read from the various reports that Malta, as a cost structure, is 30, 40, 50% lower when compared to Dublin and Luxembourg. It's not just the listing fees, it's the cost of operating the ETF as well. So there might be an opportunity for Malta where there are niche products, though.
And when you're talking about niche products, do you have any specific products or types of products in mind?
Taking the cue from Joe's
Joe,
earlier discussion. Maybe access to the North African market, I don't know.
You know, there's an ETF for pretty much everything out there. I mean, I've seen some really weird ETFs. You know, like I said, commodity ETFs. By the way, now we have strategy ETFs. Just a year or so ago, PIMCO started up their bond ETF, and their bond ETF is actively managed. So now you have actively managed strategies within these ETF wrappers. By the way, guess what? There's also an M&A ETF for merger and acquisitions. There are a number of hedge fund replication ETFs. There's a CTA ETF. I mean, look, if you're ingenious, by the way, you know, I assume that the only reason why we haven't started a Malta Stock Exchange ETF is because we don't think that there's a demand for it. But, you know, if someone's ingenious enough to do it, and if, you know, if they want to seed it, you know, you can come up with lots of different ideas.
Any other opportunities you see for ETF, for the Maltese fund industry in relation to ETF?
I mean, the opportunities, as was mentioned, is more on, I think at the moment, is more on the back office part of thing for the ETF provider. But again, Joe's right. If there's anyone ingenious enough to offer a niche ETF, why not having it out of Malta?
Okay. I think the fundamental is, to the extent that you see these slides and they say, actually, guys, where is the growth sector going to be in asset management? And you say, oh, it's going to be ETFs, then I think from a financial services perspective, the more you can do to see how you can get some entry point in there on some factor of, you know, certainly from a back office perspective, administration, you know, domicile of the product. It's got to be something that's worth looking at, rather than sort of sitting here in 10 years and saying, oh my goodness, didn't Ireland do really well out of that, or didn't Luxembourg do really well out of that? Why did no one else, you know, even bother to think about it?
By the way, you know, another point is for every ETF that opens, there's another ETF that closes. The economics of managing an ETF pretty much suggests, at least in the US, that the ETF has to have assets in the vicinity of $80 million for it to be economically viable. Last year, there were some 200 or 300 ETFs which closed globally. So, you know, it's not difficult for an ETF to fail. When I say fail, I mean fail economically.
I think it's maybe time now to take a few questions from the audience. I don't know who wants to start, who wants to break the ice. Gentleman there.
I see the ETFs as efficient for the institutions because they have large pools of money, they want to diversify. When it comes down to the retail level, though, I think we have to be very, very careful because if you have ETFs which invest in real financial instruments, it's okay, as you said. But if you have ETFs which are leveraged in some way, and these are acquired in very small portfolios, then the effects can be quite dramatic. And apart from the fact that some ETFs are complex by design, and one of the main regulatory obligations is to disclose the nature and risks of these investments. I know Joe made a valid point that investors should educate themselves, but I think regulators see it from a very different angle. It is from the distribution side that they would expect those who are distributing these types of products to really describe the nature and risks associated with these instruments. So in actual fact, I see that ETFs, although they are quite efficient and the market is growing quite significantly, I think they do pose a threat if they are not explained quite well to the retail investor, and they are also offered in terms of a wide and diversified portfolio. I think there is significant risk if these are sold to retail investors not having a well-diversified portfolio.
Okay. Jonathan, maybe you would like to react to that?
Of course, I think that was a good regulatory speech. I think there is a sort of particularly European point here, and it's sort of regulatory unintended consequences that by putting ETFs through the UCITS wrapper, that does mean by definition that they can get into the hands of retail investors, which is why you have had all this debate about complex and non-complex UCITS, which are, ultimately sort of boils down to who should really be investing in them from a retail perspective, who should be investing in them from an institutional perspective. I think there are probably sort of a number of ways of looking at it. One is that, and this is probably going to be Joe's point, which is it is not good to try to stifle useful innovation in an investment market simply because you are scared that the product might get into the hands of people that don't understand it. And that isn't a fault necessarily of the ETF industry, that's more a fault of the framework that people are using in Europe having these unintended consequences. I think certainly from a British perspective, and the work that the FSA, now the FCA, has been doing in the UK, has been more around the role of distributors and the provision of advice, and trying to focus more on the situation that advisors actually understand what it is that they are selling to their clients, where those clients are not sophisticated. And ultimately, I suspect that is probably the right way to go, because I think it is probably inevitable that the ETF market is going to grow. I think it is inevitable that where the sort of funds, the sort of regulatory architecture for funds is in Europe, that it's going to end up being done through the UCITS mechanic. We could have a totally separate panel about sort of hedge fund UCITS and UCITS, complex UCITS, or whatever awful term you want to call them. But I think and that opens up a sort of totally different can of worms. But I think there is a balancing act that is important. And I think the regulatory perspective, they'll say that they want the industry to be responsible itself. And I think, given that you've got a concentration of providers, I think when you look at people like BlackRock, when you look at people like iShares, I think that they are very sensitive to where products end up. But I agree that I think this does have the potential to be, sort of quite big from a sort of mis-selling perspective. But that isn't of itself the fault of the ETF. It's to do with the people who advise unsophisticated people to invest in them.
The multifamily office model. Now, obviously, in the United States and in Europe, they're obviously regulating a lot more heavily family offices that are considered essentially investment managers, which often differs. I often deal a lot with developing market clientele, and they've got a family enterprise and also an investment management arm, and of course the returns they're getting and the way they're managing it is very, very different. But now that they've obviously moved in on multifamily offices where they're managing money, what do you see are regulatory issues for single and multifamily offices? Which you've got a cluster of them. Okay, yes, the single family office, it's their money, so they should be able to do what they're doing, and they can even financially qualify in terms of to get involved. But what do you see of the regulatory and other issues for single and multifamily offices?
If it's regulatory issues, I'll try again. I think from a European perspective, I think the answer, Peter, to your question is regulators are, to a certain extent in asset management, proceeding from a basis now where they think that the whole of the world needs to be protected against evil asset managers, evil fund managers, whether they're institutional clients or not. And the other thing that everyone will be thankful for is we got through a panel on funds so far without anyone talking about the European Alternative Investment Managers Directive, which is something that ETFs will want to stay well away from. That, if anything, is designed to protect professional investors partly on the basis that professional investors look after pension funds, and pension funds are individuals. And there are certain exemptions, ill-defined exemptions in there, for family offices. I think equally, though, it's almost a similar kind of point as the gentleman made on retail investors, which is, where do you draw the line, and who really is responsible for determining how sophisticated a family office is, whether it's a single family office or a multi-family office, because family office itself can also cover a multitude of different organisations. So I think it's tricky from a regulatory perspective to say that there is any sort of specific approach. And if anything, I think the regulatory approach has been to listen to representations that have been made by family offices as to why they shouldn't be subject to regulation, and to give them a bit of a break. And if I'm being incredibly cynical, on the basis that if really rich people lose money, they've only got themselves to blame.
By the way, if I can just get back to that point, a number of people here seem to be looking at the risky element of ETFs, and clearly there are some elements, there are some negative elements to ETFs. Obviously, we talked about the risks in inverse ETFs, et cetera. But, we're losing sight of the fact that ETFs, by definition, give you diversification. So, for example, there was a time where if someone had $3,000 or 3,000 euros, they would take that money and maybe divide it into two stocks. Well, guess what? Now if you take that $3,000 or 3,000 euros, you can put half of it in the S&P 500, and you can put the other half in the Russell 2000, and now you have exposure to over 23 or 2,400 stocks because there's replication between the two. I mean, that's a lot of diversification. Guess what? There's an ETF out there called LQD. It will give you exposure to U.S. investment-grade corporate debt. There are over 300 names within this ETF. That is huge diversification. That in itself is a great way to reduce risk. Let me say something else. Let's say you're an institutional portfolio manager, and let's say you want to reduce the risk in the portfolio, but you don't want to create a tax event. Well, guess what? You can go long a VIX ETF. A VIX ETF is an ETF which will do well if you have a risk-off environment and if you have volatility go up. Not to mention the fact that you can go into a gold ETF, or you can go perhaps into a CTA ETF, which tends to be negatively correlated to the S&P. So I think it's a good thing that we look at the risky elements of ETFs, but it gives you quick, fast diversification. Let me just make this last point. About 10 years ago, when I first got here, I was reading the Malta Times, and it was in the middle of August, and there was a financial advisor here in Malta. And there was this nice little advert, and the advert said, we are going to experience shutdown this week, which pretty much means that they're going to close up the shop and go to the beach. And my first reaction was, okay, fine, but what happens if there's a meltdown in the markets? I'm supposed to find you on the beach if I want to close up my positions, right? So, with ETFs, it's just a question of turning on your computer, putting in your password, and if you want to close out your SPY exposure or your NASDAQ exposure, just a couple of buttons. So I see ETFs as a way to manage risk not as something which creates risk. And by the way, the gentleman mentions, I hate to sound like I'm a salesman for the ETF industry, but the gentleman mentioned something about inverse ETFs. You're right, there clearly is risk to inverse ETFs, but to my knowledge, I think there are a few ETFs which have 5x volatility. Leverage. Now, anyone who's traded futures knows that by definition, when you put on a futures trade, sometimes you're looking at over 30 times leverage. And then there are currency people out there who trade currency accounts that have 200 times leverage. So I don't think 5 times leverage, although it's high, when you see that loss in the account, you're going to get a pretty quick education, of how much money you just lost, as opposed to a futures position where you can literally get wiped out. You can get a margin call in a day.
If you were trying to form a dream team and the right people, what would be your checklist or criteria of the types of people you want in there managing your money and what they should, the skill sets they should have to basically execute and obviously grow that investment capital to a greater degree?
Well, my guess is you want someone who's, one good thing about getting old and working in finance is apparently financial professionals are the one industry where getting old is a good thing. People trust people with white hair. In fact, I'll tell you a funny story. I worked for a fund once, and the salesman took the client into the trading room, and afterwards the client said, "You know what, I'm not going to invest with you guys." And the salesman said, "I'm sorry to hear that." He said, "Why?" And the salesman, the institutional client said, "Because you don't have enough white hair in your trading room." So, you want to get people who've been around. You want to get people who have some training. You want to get people who have experience managing money. Because believe me, if you manage money for 3 or 4 years, you think you're a hotshot if you have a couple of good years. But if you experience a nice recession, you come down to earth. So, if you want to get humble, manage money.
I would maybe like to give each of you a couple of minutes for some concluding remarks, maybe with a forward-looking perspective, what you see as being the trends for the future in the ETF industry, maybe also in terms, Jonathan, of regulatory developments. Who wants to start?
Sure, I can start. You have to have common sense. I don't think you have to have a PhD in risk management to understand that diversification is important. You have to be careful with leverage. I love Warren Buffett when he says that the two things which will ruin a man are liquor and leverage. So the fact of the matter is it's really common sense. Watch the leverage, watch the diversification. Yes, invest in ETFs, diversify your portfolio, stay away from inverse ETFs, stay long, and embrace ETFs, learn about them because they're here to stay, and they're there to help you generate alpha and hopefully make you, good returns.
I think ETFs are bound to grow, especially in Europe. They're an excellent vehicle. You can get easy, quick, and efficient access to markets and to assets. The thing that we should concentrate on is understanding exactly the implications of the structuring, knowing exactly what one is buying, and making sure that the ETF industry itself presses on disclosure so that whoever is buying their products knows exactly what they're buying, what they're paying for, what their cost of holding that ETF is, where the conflicts lie in the structure. As long as there is all this information, then an advisor can advise. Then an investor can know exactly what he's buying.
I think I'd second what people have said already. I think, as far as I can tell, ETFs are here to stay. I think they match a lot of what people expect at the moment from asset management. I think there's a fair amount of regulatory catch-up that needs to be done. I think to take Aldo's point, and forgive me for mentioning the securitization word, there is nothing inherently wrong with ETFs at all. There's actually nothing inherently wrong with securitization. The issue is the extent to which those who use it do it responsibly, and there will always be, from a regulatory perspective, there will always be a minority that give regulators cause for concern, but that shouldn't detract from the quality of the product overall.
I think that's an excellent conclusion, and it remains for me to thank you for your participation and to ask you to join me in uploading the panel for this, what I thought was a very interesting and lively debate.